Hey, everybody. Welcome to another episode of the All In Podcast. Yes, we're still publishing. Yes, we haven't been canceled, but it's early in the show, so you never know. With me again, the dictator himself, Chamath Palihapitiya, the Sultan of Science, David Friedberg. Whatever beverage you like, he'll make it for you right now in his replicator. And of course, yeah, the Rain Man himself. Yeah, definitely going to win the midterms. Yeah, David Sacks. Everybody have a great week getting their asses kicked in the market?
I'm pretty good.
You're okay? Everybody okay? Nobody jumping out a window?
I can't look at my portfolio anymore. I just stopped checking it.
Not a fan of the color red.
I actually, I've been using this period to kind of desensitize myself. I went back and I started to think about like all of the sort of errors of commission that I've done in like the last decade. And I was able to look at like 4 or 5 specific trading moments where I was like, wow, what did I do that for? And I came away with 2 things. One was if I confuse an investment with a trade, I'm done for. Meaning like there are things that you invest in that you just want to own forever. And then there are things that are trades that are just speculative. And, you know, at the end of the day, you have a sense that it could be up in the short term. If I confuse those 2, I've made huge mistakes. And then the other one is I would always get really emotional and panic at the lows. And so I was like, you know, in early December or November, when I wrote that letter on Twitter and we talked about it, and I sold a bunch of stuff after Jeff and Elon were selling, raised some cash. And I was like, okay, now I have enough buffer here. The whole point from here on out is to basically like insulate myself from my own emotional turmoil as the stocks go down. And so far, so good. And my litmus test, if when I go home at the end of every day, you know, I check in with Nat and I'm like, am I an asshole? Because
She's like, yes. What does that have to do with investing?
When I get crushed in the market, I tend to take it out on my friends and my loved ones. Honestly,
yeah,
because
we're
I'm
your
just
friends. We know. We come to your poker game when your stocks are down, and you're just like,
oh my God,
run it once. That's it. I'm popping the blinds up. I can't take it anymore.
Do you remember last year, Chamath, during the market collapse when at the start of COVID, and you decided you didn't care about having nice jeans anymore, and then you fast forward to December, and you were proclaiming the virtue of a $5,000 fresh alpaca sweater or whatever. I think another indicator of sentiment in the market for you is your clothing.
Oh my God,
choice, but.
This is a really nice cashmere ribbed sweater from Loro Piana.
Okay. Well, we're back in the game. It's good to see we're back to normal now. Yeah, let me ask you then. I'm going to put a couple of items out there. Is Bitcoin a trade for you or an investment for you? Or was it and is it now?
Well, I invested it in 2011 at $80.
Yeah, yum.
I wrote an op-ed in that same year in Bloomberg, which I hope at some point they take off the paywall.
Yeah.
And the whole thing was you should have 1% of your net worth in this thing.
Yeah.
It's remained an investment ever since.
So still an investment.
Yeah, I've structured it so that I don't hold any Bitcoin personally myself because I don't want to have the pressure and the risk of keys and coins and wallets and this and that. But I still really believe in Bitcoin in the long term.
Got it. Sacks, how do you deal with the emotional turmoil of opening up your stocks, crypto, whatever wallet and seeing red and then going to work every day? Or are you just curled up in a ball playing chess with Peter Thiel at this point?
Yeah, I mean, you just got to try and ignore it.
Okay. Try was a key word in that sentence.
It doesn't really affect me that much. I mean, so
I run the avoidance acceptance function.
I have removed my emotions.
No, look, there are countervailing benefits. So when exit prices are great, entry prices are lousy, and when entry prices are great, exit prices are lousy. So there's an inverse relationship. So in other words, all the companies that, I mean, the public markets have massively corrected, and now finally, you know, we talked about this a few months ago. Those new price levels have trickled their way down into venture markets, and so finally, you know, venture deals are starting to price at more reasonable prices. So, in terms of harvesting gains from old investments, obviously it's not as attractive as it was 3 months ago, but in terms of making new investments, it's much more attractive. And for a relatively young venture firm, which is what we are, you know, we do have some investments that are kind of in the harvesting stage, but, you know, we're only a 4 or 5 year old firm. We're still the bulk of our activity is making new investments. So, it's all just kind of part of the game, and I'm not really that worried about it.
Said another way, fortunes are made in the down market. They're collected in the up market, is the way I always phrase it, but it's true. Things are going to be on sale right now. And we saw Bill Ackman, I think, who I think is a friend of the pod. I think he listens. Yeah.
Super smart, brilliant guy.
Yeah. And I just want to emphasize, because I don't want founders to get the wrong idea. It's not like we're trying to pull one over on founders and get some sort of sweetheart deal or something like that. My view of like our role as VCs is just to be a price taker of whatever prices the market sets. We don't try and negotiate something better than market, really. We just take the market price and we pick the companies we want to be in. So that's our job, is really just to pick, not really to negotiate that much.
You're not able to haggle. It's not like you can go to
exactly. The markets are too
supermarket and be like, oh, bananas are $1 a pound. I'll take them for 50 cents. They're like, oh, sir, this is a Whole Foods. We don't negotiate prices.
Right. So we're a price taker in good markets or bad markets. And it's just that I think that the prices now are coming down, because what I've heard is that the crossover investors like Tiger, like Coatue, who are deploying all this money, they've really slowed down now. I think they're all kind of licking their wounds. And so like all of this money that was flooding into the venture space is kind of on pause right now. And that's caused the price levels to drop.
The end of last year in Q4, my public portfolio really started to turn over. Took a huge amount of losses going into the end of the year. And then I took an accounting, obviously, of like the entire book, and the public portfolio, every single thing that I owned, ultimately basically broke even last year. Some were up. I made some early sales. Some were way down by the end of the year. Net, I kind of broke even. But my private book was up $1 billion. And I told the team, I'm like, no, this is not real. So we have to take those marks, because, you have other venture firms that are pricing these deals and we get audited K1s. And so we have to take the up billion. But I told them, you should consider this, that we had basically a down, so net, our returns were like, we were up like 15%. And I said, this is not real. We were at best break even, and probably we lost money. But you can't not take these marks, because you have an entire fund complex that lives on these marks.
Yeah. And by the way,
it doesn't affect my compensation at all, but I have to take it.
Friedberg, then Sacks. Go ahead, Friedberg.
No, it's a really important point, because I think we talked about this 1 or 2 episodes ago. But there's a significant disincentive for venture firms to take markdowns, to raise capital into a private business at a price that's lower than the prior round. Because when they do that, the marked value of their portfolio goes down, and then it makes it harder for that venture firm to go out and raise the next fund that they're going to try and raise from their LPs, because it looks like they're not good investors. And the reality is, and so in every round, as everyone on this pod knows, there's always an incentive and a push to see, can you get the valuation higher, even if the business performance didn't meet the objectives of the prior round and things have gone sideways a bit. Doesn't necessarily mean that it's a bad business, but it doesn't necessarily mean that it should always be getting an up round just because it's being kept alive. And there's this artificial pressure in private equity in venture to always drive the value up or to run away from the company. Because otherwise you're going to have this markdown, and you don't want to be putting money in at a markdown that looks like a loser, and so on. And if you look at the public markets, every successful company has had significant downturns in their stock for significant periods of time, from
Facebook,
Apple to
Amazon.
Google to Facebook to Amazon to Netflix. And all of those businesses were sound businesses. It's just that for whatever reason, there were perturbations in markets, perturbations in the business, but the long-term value creation was still there. And so I think we need to kind of, be really thoughtful, and entrepreneurs should be very thoughtful not to give in to the venture mandate to always drive value up, but to be really thoughtful about getting the right valuation for your business and getting the capital you need with the right partners.
Can I say something about this? It's so important what you said. One of the tactics that I started 3 years ago was I run my own shadow portfolio, where I don't take the marks and I just keep them at my cost basis. And I'm not allowed to use that for anything. I can't use that. Obviously, I would never use that for compensation with my team or anything else. But I use it in my own head to say, okay, if I invested $1, let's not think about what somebody else may think about what that dollar's worth. Let's just keep it at $1, unless it's impaired. But I don't take the markups. And I look at my portfolio that way. But it's a very difficult thing to do. And the reason I do that is because I don't have the pressure to raise incremental funds. But if I did, I wouldn't be able to play that game. And I'd be very focused on making sure other VCs marked up my deals. Because to your point, it takes 10, 12 years to drive liquidity, literally.
That's the key here. Yeah.
And so what are you supposed to do if you're a venture business in year 3 or 4, except raise money on markups? Paper markups are they're the
lifeblood of
engine.
a venture.
It's the lifeblood of what keeps this industry going.
Yeah, totally.
Well, I mean, the interesting thing for me is I LP'd a couple of these small, like emerging fund managers, micro funds, 10 million or so, 3 million. And they were sending like a lot of updates. And so I'm in some top tier venture firms that some of you are in, and they send you an audit every year and they send you a distribution, cash on cash. Here's where you're at. And then I was getting like quarterly emails as everything was going up. These new fund managers are like, we're at 100 IRR. We're at 200% IRR because this crypto investment we did got marked up. And I was just thinking about what Bill Gurley would always say, which I think is a Howard Marks quote, you can't eat IRR. Like, what are we doing here? Like, why is there such a focus on this? Is because you want to raise your next fund. And then the other game people were playing was, and I got into this because people were like, oh, you're grossly undervaluing your funds because Robinhood is trading at $30 a share on the private markets. Calm is trading at this on the private markets. And people were using secondary market transactions as their mark. So I'm curious, Sacks, how do you think about if you invested in a company, the Series B was $100 a share, but then somebody bought it at $150 a share in the private markets? Where do you like to mark that in your funds, or how do you think about that and getting ahead of your skis in terms of valuing your private funds?
Well, to Chamath's points, we have accounting rules around this. So we can't like subjectively decide like what mark to set for each company for, obvious reasons. Our LPs want like a predictable accounting. So the way it generally works is that the mark is set by the most recent private, financing. This is the way it works. And if people want to discount it from there, they certainly can, What about a secondary transaction? Is there any more complicated rules around that because it's a different class of stock? So it's some combination of, sometimes we use a 409A, sometimes it's the latest preferred round. It's, there's like complicated rules around it.
By the way, I'll just to rehash what was already said, and just to say it one more time, Chamath pointed out that it typically takes 12 years to liquidity from the time a startup is initially funded to the time that you sell it or go public. Show me one public company that has had 12 years of consistent gain in its stock price. It doesn't exist. And so again, like this notion that every startup is seeing some perpetual, persistent increase in value is an artifice that doesn't really represent.
It doesn't exist in tech, and that's a feature, not a bug.
Right.
Meaning the things that can go up predictably for 10 to 12 years are not necessarily businesses.
They're not disruptive. They don't take risk.
They're not dynamic.
No.
They don't take risk. Yeah.
Sacks, can you define perturbation for the audience? I heard Friedberg say that a couple of times.
Perturbation would be
changes.
What, like volatility, basically? Yeah, rapid change.
Anxiety, mental uneasiness. Okay, a cause of anxiety or uneasiness. Okay, I got it. I thought you were setting another word.
You don't use the word perturbation?
I thought you said another word.
What word was in your brain?
I thought I heard masturbation. I was like,
masturbation.
Wait a second. What exactly did he say about the markets?